so far it's BDO people that are showing up. Your people are prompt.
Perfect, perfect.
Welcome everybody. We've got a couple people starting to show up. We'll begin very shortly with Daniel from BDO. Just give a couple minutes for everybody to arrive and then we'll get going. So Daniel, are you, I know I was talking to a Lim last night, and he's doing a lot of work wrapping up some of the personal tax stuff for people. Or do you get involved in any on the personal tax side, or are you not having to be challenged with this June 1st deadline?
Yeah, so thankfully, I'm in our valuations and modeling group, so I don't have to get burdened by the the tax deadlines. But in working with some of my colleagues who are in the tax groups, I do know it's it's definitely a rush right now. It's I guess 2 or 3 days to the June 1st deadline. So I'm just happy to be able to present here as opposed to powering through some tax returns.
Which is never fun at the best of times. I know that talking to a Lim last night, he was at our meeting last night, and you could tell he was getting to the end of that road, right? It's like running a marathon and having to sprint at the end of it.
Exactly.
So, all right. So we got some people here now, and so what we'll do is Daniel, for sake of time, I want to make sure that we have an opportunity to get through the presentation and create some time for questions and answers for people. We will be recording this, so we'll be able to get this out to our members that weren't able to attend, and also be able to get this up into something available to some of our portfolio companies. And I think what we'd like to do is also, I think at some point in time, make sure that we can get this out to founders as well. So I want to introduce Daniel Ma to the group. We're happy to have him here from BDO Canada. We have a presentation on creating financial models. It's broken up into 5 sections, so there will be some break points in for Q&A, but we do encourage everybody to be able to use the chat function, the Q&A function, and raise a hand as well. There will be a Q&A session at the end, and so we will be able to unmic people if they want to ask questions directly. So again, you can use the raise hand for that feature at the end, and we can open up your mic and you can ask Daniel questions directly. But Daniel, without further ado, I'm going to pass it over to you, and thank you very much for your time.
All right, perfect. Thanks so much, Galen. And yeah, so Galen, when questions do come up, feel free at the break points of this presentation, just parlay or put those questions over, convey those questions over to myself, and happy to answer those. So first of all, I guess thanks everyone. Happy to be here, even though we're all working from home in these senses, but it's always good to have an opportunity to have a little bit more social interaction, obviously. So myself, my name is Daniel Ma. I'm a partner in our evaluations and modeling group. So today we're going to talk about creating financial models and why they're important. So really the first question becomes, well, what's the point of going through and creating a financial model or a financial set of projections? What's the point of doing this? Because it is quite an a rigorous process that you have to go through. And so really, when we're looking at creating financial models, it allows you to perform a whole slew of activities. So first of all, it allows an entrepreneur to articulate its business strategy to potential investors or potential lenders. So it's a means of putting into numbers the thoughts and the milestones that this business is looking to undertake. So for instance, when is there going to be a significant amount of capital expenditures? When are we going to have, research and development? When are we actually going to start to see revenue? And when does this company go from pre-revenue to post-revenue? So articulating the business strategy is something that's really important, obviously, as an entrepreneur trying to raise investment capital. That is basically going to be conveyed through the financial model. Projecting cash flows is associated with articulating the business strategy, but also looks to help understand what are the cash needs of the business. So to be able to build a financial model and understand that there is cash cushion to ensure that we're not burning cash and not getting to a specific milestone. So understand the cash needs of a business, obviously that's extremely important, and a financial model will be able to help you project that. There may be key metrics or performance indicators that are also important that need to be tracked. So as an entrepreneur, depending on the type of investment that you're receiving, different metrics may be important. For instance, if you're looking to raise capital from the government, then something as simple as, how many jobs are being created throughout this period? What's the contribution to the local economy? Things like that could be tracked in a model. Stress testing is the next important aspect of financial modeling. Being able to stress test key drivers and run sensitivity analyses is something that a lot of investors are going to look at when they start playing around with a client's model. So for instance, looking at, if we don't get the type of growth projections that the base case is forecasting, or if, instead of a half a year of R&D and, let's say that takes 9 months instead, how does that look like in terms of the financial feasibility of this business? Being able to stress test allows us to see what breaking points that this company can undertake and allows us to then appropriately measure the level of risk in that business when you're looking to invest in a company, for instance. The model also aligns with investor metrics by quantifying expected outcomes. So that's similar to tracking key metrics and tracking performance indicators. But obviously, in this case, we're looking at metrics that are specific to an investor. So lenders, for instance, might be interested in covenants. They may want to ensure that there aren't certain debt thresholds or debt levels that this company is exceeding. And so being able to track covenants using the financial information created in the model is something that is paramount as well. And finally, from the perspective of the entrepreneur, just having a good budgeting process is something that is just generally good business practice. So, this isn't something that is specific to startup companies. This is something that applies to all companies across the spectrum. Every year, it's just good planning to create a plan or a budget for yourself over the next year. And at the end of that year, compare how you've done the budget, if not even more on a more frequent basis, just to ensure that the business is going on track as expected. So, I've just described an entire laundry list of why a financial model is important. And the, in the startup space, most likely or more often than not, we find that our clients are looking to build financial models to aid in the capital raise. And so, an investor, and I'm sure there are many angel investors on the call as well, I'm sure, these are questions that you're typically asking of an entrepreneur. And the model should help answer these questions. So, I'll start on the bottom left here. How does this company compare with experiences with other successes, failures, and knowledge of the industry? So if, as an investor, you've invested in a company in a similar space, this new company that you're looking at, what do their margins look like? What does their growth rate look like? Is that actually comparable? Is it feasible to what you've actually experienced in the past? How does this proposal compare to other financial opportunities reviewed? So, having a model allows an entrepreneur to basically showcase why this is a good investment opportunity in terms of what are the growth potentials in the business, how's it planning to scale, all of those good things. Are the rewards and potential rewards commensurate with the risk? So as an investor, having a model will allow you to then look at, what cash flows are being projected out and what is the valuation that the entrepreneur is really presenting to you. And you can then make an assessment of does the forecast or the projections and the risk in those projections really match the valuation there. So, if a company is not looking to earn significant revenue over the next 2 years, should it command a $2 to $5 million valuation? For lenders, what they're going to look at is whether or not that company is going to be able to meet debt obligations. So again, I spoke to this earlier. By building a financial model, you could then build in what the covenants are and how they look like over the forecast period and ensure that there's no point in time at which the company is going to run afoul of any covenants. The growth potential of the company, does it provide an exit strategy? So as an investor, you may be looking at what is your own investment horizon or your own investment timing. Different investors want to be, or they may have different exit timing. So one investor might be looking to exit within 3 years, another may want to, ride along for, an entire 10 years, so to speak. So understanding really the growth trajectory of the business, how quickly is it going to get to that next milestone, get to that point where a liquidation event could occur for your earlier stage investors. The model is going to allow to demonstrate, how does that exit opportunity look like? Meeting internal rates of return or investment criteria, hurdle rates. Again, the model can also show at a specific valuation what an internal rate of return is, and is that going to give you a good enough return for your own investment profile? And then, what's the company planning to do with the cash? So any prudent investor is going to want to know that. They're going to want to know if they're putting their own money into this business, what are the entrepreneurs planning to do with that money? So that, again, will be articulated in a business model. And I think from a startup space, really one of the most important questions really is, when will this business achieve some level of profitability, which again, a financial model will help answer. So that brings us into, well, how do we actually create a financial model? And we've broken it down into 5 major steps. Again, as we're going through this, I'm gonna, at the end of each step, allow an opportunity to ask questions. So please feel free to think about these questions as I'm going through them. But to summarize these 5 steps, the first is really creating your income statement. So really that is a statement that shows the expected level of revenues, expected level of profit over the forecast period, which could be anywhere from 3 years to 10 years, depending on the type of business that we're looking at. Generally, at least, when we're building these models out, a 3 to 5 year time frame probably makes the most sense, just given that when you get to year 5 and beyond, there's already going, there's a lot of uncertainty with years 3 to 5 already. Getting to years 5 and beyond, there could be a lot of uncertainty, and really no one is going to be able to forecast that very reliably. But going back to the income statement, really what we're doing here is we're projecting out revenues and expenses, projecting out the impact of any debt financing, so in the form of interest, or if they're raising preferred shares in the form of dividends. Really, that's what we're looking at. Step 2 is then to build out the balance sheet. So the balance sheet, really what you're looking at is what working capital is in the business, what fixed assets are in the business, how much debt is in the business, and then ultimately, what is the cash balance? Because we want to ensure there's enough cash in the business to fulfill its obligations, to basically meet its goals. Step 3 is then to build the cash flow statement. So when we're looking at step 1 and we're looking at an income statement, typically that's an accounting income statement. So the net income is an accounting figure, but for a lot of startup companies, the accounting income is probably not as important as the actual cash amount. So step 3 really is to translate accounting income into cash flow. Step 4 is then to reconcile, and then step 5 is to allow us to perform any type of sensitivity analyses that we're looking at. So I'll first get into the income statement. This slide here basically shows, a typical income statement with some dummy numbers in there. In terms of the modeling practice here, you'll see what our convention is, and a lot of people who build these financial models will use these conventions as well, is that any cells that you're looking to adjust or to change, they're going to be in a different color. So in this case, we selected blue font with a blue highlight. So basically the way or the reason we set it up this way is that when we go back to step 5 and we start sensitizing the model, we know which inputs we can play with. So for example, on this page, I'm assuming that the cost of sales are 73.5% of sales. If I were to be able to adjust that to 75, the model will then repopulate. So this is basically how it looks like. I'll get into really what are the drivers of each of these line items. So the first is really to be able to build the income statement as the revenues. So revenues is really, if I go back, the very top line there in sales, and it's probably one of the most important metrics you can actually try to project out. When we see companies projecting revenue out, at the most rudimentary level, what we see is something to the effect of, we think we can do $1 million and we're going to get X% growth. So that's not a very good narrative, because, a lot of questions come around, well, how are you getting that growth? How are you substantiating that growth rate? Then we move to the next level, which is, we think the market is $1 billion. If we get 1% of that, we would get, my math it's not that good, $10 million of revenue, right? So again, it's a little bit better than the last, but there's not a lot of company-specific information there. How are you planning to get the 1%? There's a lot of questions there. So what we like to do is to help understand what the revenue drivers are. What are those key activities that actually drive operational performance and result in revenues? So as an example, we can look at a company that, let's say, is in the e-commerce space. Well, what drives sales in e-commerce? One is web traffic, which again can be tracked. You can look at how much website traffic has been driven to that particular website. You can then look at, well, what are the expected conversion rates? So conversion rates, we can look at other industries, other companies within that industry, and what are they basically converting at with respect to their e-commerce websites. And then we can look at, well, what's the price of the goods that are generally charged? And when we break it down into those types of drivers, that's a much, I'm from an accounting background, so I'll say that's a much more auditable revenue number. Then I can test and I can look at what my outlook is on web traffic. I can test what I think conversion rates would be. I can look at what your sales prices are, and that's a much more fulsome way to get to revenue, as opposed to looking at things like, well, what's the target market? I mean, it's good information to have, but we want to kind of dig in a little bit more than that. If there are multiple drivers of revenue, you may want to consider separating this out into separate revenue streams. So for instance, your online sales may have very different revenue drivers than your in-store sales. So, those could be two revenue streams that are separately calculated. This point about backtesting through applying assumption to historical performance, that's more so for companies that are mature. Once we're looking at a company that has a certain number of years of financial performance, we can then assess the projections and look at whether or not the assumptions are reasonable relative to how they've performed in the past. And so on the right here, I have a list of certain business drivers that are samples. So again, things like website traffic volume, number of location, number of salespeople, volume of products sold, how much product can you manufacture and the pricing of those goods and services. There are, again, a laundry list of other business drivers that could drive revenue, and it's going to be specific to each individual company. On the expense side, it's the same as the revenues. It's important to understand what are the drivers of those expenses. But for the most part, for more simple models, we'll really classify the expenses as one of two, either fixed or variable. So fixed expenses are those that do not vary based on the activity of the business or the revenues that the business is going to generate. So think of things like rent. It's you're paying a certain amount of rent every single year. Think of things like utilities. Think of things like salaries on a per person basis. So if you have 10 people and you think you're going to keep those 10 people throughout the year, that could be considered to be a fixed expense. Generally, fixed expenses move in steps. So you might reach a breaking point where your current facilities aren't enough to satisfy this particular business, so you need to move to a bigger location, and then your rent, steps up, so to speak. Variable costs, on the other hand, are typically dependent on business operations. So generally, we would base it on a percentage of sales. So think of things like cost of goods sold. The more widgets you're selling, the more cost you're expending to create and manufacture those widgets. So here's an example of how we would build that out. When we're building our model, we build switches on the left-hand side here for each expense to classify each expense as either variable or fixed. If it's variable, then the third column here, where it says 73.5%, if you type a number in there, it's going to drive really what the cost of sales is as a percentage of revenue. If an expense is fixed, so I'm looking at occupancy costs right now, rather than having it fluctuate based on revenue growth, I may fluctuate it based on what the expected inflationary growth of that expense is going to be, or I might even put 0 and just say it's going to be a fixed expense throughout. There may be other expenses where you want to individually track them and not just go as simple as fixed or variable. So right now, salaries I have it as fixed, but salaries is something where you may want to break it down and look at, well, what is the headcount expected over the the next 3 to 5 years? What's the average salary per headcount? And then a simple multiplicative calculation to calculate what your salaries expenses are going to be. Essentially, on this, we're then going to drive all the way down to net income before taxes, apply tax rate, look at whether or not any dividends are being paid, and that's going to lead to a change in retained earnings, which should then flow through into our balance sheet. On the debt side, so if I go back a slide here, one of the major expenses for companies that are looking to raise financing, and if they're able to get debt financing, is going to be interest. So that again would be separately calculated as opposed to being a fixed or variable expense. It really depends on how much borrowings that company is taking. So it's important to model out the impact of financing. Generally, the types of financing available to the company are going to be reliant on a certain number of criteria. So things like financial shortfall, is this company, if it's lacking financing, there may be only certain avenues of financing that are available to it. What stage of its life cycle it's in, how much growth there is, the cost of financing it's willing to pay, and then the covenants that it'll be able to meet may drive the level of financing available to it. So here are certain examples or common examples of financing. I think we're going to provide, or I know we're going to provide the deck afterwards. So, I'll leave this for the audience to read as opposed to going through them one by one. So here is a natural break point. I saw some hands, or at least some flashes. So Galen, were there any questions?
As of right now, no. The flash are probably people. I put some chat into people to just start asking questions if they have some,
Okay.
but nothing coming in yet. I think this is all really good stuff. I suspect we will get some questions toward the end here, though.
Okay, perfect. So if there are no questions, we'll move on to the creation of the balance sheet. So this is an example of how a balance sheet looks like. Really at the top, I'll step back. The purpose of the balance sheet is to be able to show a snapshot of what the company owns and what the company owes at a particular point in time. So in contrast to the income statement shows performance from the beginning of the year or the beginning of the period to the end of the period. So, the December 31st, 2020 means the performance from January 1st, 2020 to December 31st, 2020. The balance sheet is a snapshot. So it's really on December 31st, 2020, what does this company own and what does this company owe? It does not, contemplate how the company looked like on December 30th or December 29th. So that's an important distinction to make. So the point, again, of that balance sheet is to provide a snapshot of how the company is going to look like on these particular dates. And on the top here, we highlight what assets the company owns. Generally, the assets are going to be separated between current and long-term assets. So current assets are those that are going to be, typically they get converted within a year or so, whereas long-term assets are held for longer than 1 year. So think of things like accounts receivable, inventory. You're turning that over more often than once, hopefully in a year, and so they would be current assets. On the bottom, we have our liabilities. So similarly, the liabilities are split between current and long-term liabilities. So current liabilities examples are accounts payable. You're paying that off more than once a year. They're current in nature. Long-term are going to be more so the long-term debt that a company borrows. So if they're borrowing, they have a mortgage on their balance sheet for 25 years, that's long-term debt. And then we have shareholders' equity. And so equity is really the difference between assets and liabilities. So in essence, this is from an accounting perspective, the amount owned by the actual shareholders as opposed to the amounts owed to its creditors. It's very important for this balance sheet, it's in its name, to balance. So you'll see what we do here is we ensure that the assets equals the liabilities plus shareholders' equity. So that's really what a balance sheet looks like. We'll now get into how we actually came up with the numbers underlying this balance sheet. So the first were really the current assets and the current liabilities. Current assets less current liabilities is more commonly known as net working capital. Working capital, it's the inverse there, right? So really when you're looking at projecting out what the current assets are going to be, we look at things like important working capital turnover ratios. So examples are days in accounts receivable, days in inventory, days in accounts payable. So if we know what we're projecting out in terms of sales and in terms of cost of sales, a simple calculation will then translate into what the accounts receivables are. I'll provide those formulas afterwards, but really this is an example of how that looks like. So you'll see if I go back, there's a little 1 beside all the all of the current asset and current liability line items. And really that little 1 corresponds to a note that I have here, which basically provides the details and the assumptions that I'm going to use to create, or project out those working capital accounts. Again, I'm using blue font, I'm using a blue highlight. When you actually see this in Microsoft Excel, a user can basically start adjusting some of these assumptions and seeing how our new AR or AP balances look like if, instead of collecting every 180 days, we're collecting every 90 days. So this is really a breakdown of AR or AP or working capital really. So again, it's generally implied based on target days and turnover. So I was, the example that I alluded to at the last slide there. Here are some examples of working capital accounts. We went over it. And really, working capital is an important measure to understand because it drives cash. So that's something where, again, accounting income is it's not as great of a measure in terms of measuring cash because it doesn't take into account the fact that you may not have to actually receive the cash or may not have actually paid the cash if you're looking at it from an expense perspective. So on the right hand side here of the slide, as an example, if you had $1 million in revenue, and let's say you had no expenses, your accounting income is going to show $1 million. But that's not really the amount of cash you've collected over that year. If it takes you 180 days to collect the cash, then of that $1 million of revenue, 500,000 of it actually hasn't been collected. So you actually only have $500,000 of cash and $500,000 of AR. So that's a very different perspective in terms of how much cash you have from an accounting. Like if we're looking at just revenue and how much, so $1 million of revenue is not $1 million of cash. $1 million of revenue in this case is actually only $500,000 of cash collected. So if you are anticipating cash shortfalls, one way of alleviating that may very well be to try to collect the cash faster and not have as much cash stuck in AR. And it's the reverse on the payable side. So that really demonstrates why the working capital is so important. It basically shows you, truly what your cash looks like as opposed to the accounting perspective. The other major.
Sorry, Daniel, just a quick question on that, because obviously when we get into SaaS type of income, from an exercise on the, if you're collecting an annual subscription rate, from a modeling perspective, you're taking that money in. How do you end up accounting for that in this kind of process? Or if you've got an annual contract but they're paying monthly, what's the exercise around that from a SaaS point of view?
Yeah, so that's actually a great business model. So what I described was more of your traditional business models where it's I give you the item first and you pay me later, right? And I'll call you and I'll get my collections agency to call you if you don't pay me, right? But with models where the customer is paying cash first for service to be delivered later, those could have negative working capital. And really what that means is that essentially you as a customer give me cash. On my model, what I'm going to show is that I immediately have a cash uptake, but I have a liability now. And that liability is represented in deferred revenue. And really what that means is that I have a liability to fulfill that obligation to you. So when we model it out, we just ensure that the timing of the cash receipt and the timing of the expenses are just going to be flipped. But again, it's more of a mathematical thing, and by just incorporating this in the model, you'll capture that.
Okay.
But that's a great question. I think it's very common today where we're seeing a lot of SaaS models, obviously. So the other side of the balance sheet, or not the other side necessarily, but still on the asset side, are those long-term assets. So the long-term assets, because they don't get turned over every year, it's important to really show, when we're acquiring these major assets. And this is especially important for startup companies. So understanding, how much growth CapEx there is, how much CapEx is attributable to expansion and it's more one-time in nature, and how much capital expenditures are related to maintaining the business. And it's important to then tie this in to the income statement and the revenue driver specifically in that income statement. So as an example, there needs to be congruity between capital expenditures and revenue growth. So I can't go and say I'm going to grow revenue by 100% every single year and then not show that, especially if I'm, let's say, manufacturing, that I'm expanding my production capabilities to be able to meet that 100% growth? So these are questions that a trained investor is going to ask of an entrepreneur is, is there enough investment in this business to actually, meet its revenue targets? So, a very common mistake that we see, at least, when we're working with some clients or when we're looking at less experienced models, it are those where, revenue growth is very optimistic. So the idea that, I'm going to growth hack, or the target market is so large and if I just get 1% of it, I'm going to make all of this money. But then that's not reflected on the expense side, and that's not reflected on the capital expenditure side. So, if you're forecasting significant revenue growth, the question is going to be asked of, do you even have the production capabilities to meet that revenue growth? Are you investing enough in the business? And that's, different than from maintenance capital expenditures. Maintenance capital expenditures are just, over time, if you own the building that you operate out of, you might have to replace the roof or things of that nature. So those are really the major items on the balance sheet. The other one I'll add, just to kind of go back some slides here, is on the debt side, being able to to forecast out the liabilities of the company. Generally, what we'll do there is, again, it's more specific to the terms of that particular debt, but we'll look at, when principal is owed, when interest is owed, and then what's the remaining balance. The interest payments are going to be an interest expense on the income statement, but the remaining balance of that debt is going to show up as a liability on the balance sheet. And then that basically gets us really to the residual, which is equity. Really that's going to be the change in retained earnings from your income statement. So before I move on to the cash flow statement, were there any questions on the balance sheet?
I don't see any questions coming in, but I think the one comment, and we often hear this from a lot of engineering-led startups, is that idea around the growth cap expense, where I think we often hear from founders saying, "Oh, product is easy. We can make that really easy." And usually it's a couple of founders who are making this in their own basement, or they're using some lab, and they're hand making their first prototypes or their first pilot products, and not really fully grasping how to now take that and move it to the next stage when I start getting volume. And often, that becomes the real push around how do you make sure that they can grow properly. So I think it's a really poignant area that we have to be able to focus in on, is that whole growth cap expense side for startups as they go forward.
Exactly. So, we'll move on to cash flow statement. This one I won't spend a lot or too much time on. The cash flow statement is more of a mechanical exercise. Really what we're doing here is, again, we're converting accounting income into true cash flow. So in the accounting income, for instance, we basically deduct amortization to get to accounting income. But amortization isn't a real cash expense. You don't pay for amortization. Rather, you pay for the equipment, and then the equipment amortizes over time. So this is an example of converting accounting income to cash flow. Really, we're going to add back the amortization because that's not a true expense, but we're going to subtract the capital expenditures because that's a true cash flow. Similarly, with your working capital, if your AR balances are going up, it means that you haven't collected that cash, which means that's a cash outflow. And it's the flip on the expense or on the payable side. If your payables are going up, it means you aren't paying them, which means you actually are preserving the cash. So those really, the first page here, or the first segment here, is the cash flow generated from the operating activities. So net income plus amortization plus an adjustment for the working capital changes. Those are really your operating activities. And so that's your cash flow from your operating activities. From an investing side, this is, again, think of it from the perspective of a entrepreneur investing in their own business. So if they are basically spending money on capital expenditures, that's a cash outflow. And then there may be cash from a financing perspective. So in this case, I'm showing a $2,000 payment every year to satisfy the debt. That could be a positive number if we are actually seeing that we're raising capital or raising debt in that particular year. And then that leads to our change in cash, which then shows whether this is a cash positive or a cash negative operation over the year. I think I saw something flash. So Galen, was there a question?
Yeah, so it's just Frank, one of our members, is saying we'll be chatting about valuation, and I think that maybe at the Q&A at the end, we can sort of bring some of this around into, because I know that we had your video in our investment meeting yesterday on valuation, and maybe we can have a discussion when we wrap through all the modeling, is then how does this equate, or how do you then measure this against potential valuation of a startup when we're trying to analyze them at the beginning stages?
Exactly. Okay, perfect. Yeah, we'll answer any valuation questions during the Q&A as well. But generally, the linkage here is that the way we're going to value most startups is by using a discounted cash flow analysis. So being able to project out what the cash flows will look like over the next 3 to 5 years and discounting them back to present value is the approach we undertake. So obviously, to do that, you have to have that forecast, which is what the modeling allows us to do.
Right.
Right. So we kind of talked about this already in terms of the cash flow statement. It allows us to understand our cash position, whether it's cash positive for the year or cash negative for the year. And really, it's going to allow us to analyze whether or not there are any cash shortfalls that we foresee, and then how are we going to fill that gap? Are we going to actually cut costs, or are we going to look at another financing round? What's our approach there? And so on the right, we have typical cash inflows, so your revenues, any additional financing you're raising, and then the cash outflows being obviously your expenses, tax, CapEx, and any loan repayments. I think I saw another question there.
Oh, no, it's just Frank thanking us for that.
Oh, okay, perfect. Yeah, sorry, I apologize in advance. I just see the little flash, so I'm not seeing the chat screen just yet. So now we'll move to step 4, which is to reconcile the financial statements. And so this is more, again, the mechanics of the financial model, as opposed to any major theoretical accounting concepts or finance concepts here, right? This is just to ensure that the model has its own internal integrity. So for example, we'll check that the balance sheet actually lines up with the income statement. So let's say if you look at, you're projecting out 2020, for example, the income statement is going to imply a certain change in retained earnings in that fiscal year. So then I'll look at my balance sheet and ensure that the change in the retained earnings from 2019 to 2020 equals what it's implied by the income statement. I'm going to check balance sheet consistency so that, again, my assets equal my liabilities and equity. And I'm also going to check that my cash flow statement makes sense. So the change in cash on my cash flow statement equals the change in cash on my balance sheet. So these are just checks to make sure that our model is working properly. It's generally very good practice to build in a lot of checks in your model as well. Typically, what we do in our modeling is we build conditional formatting. And so if something doesn't balance or doesn't check out, it'll change color. So example, on the balance sheet here, at the very bottom, we have a balance check. So if the assets or total assets does not equal total liabilities and shareholders' equity, it's going to be a big red X as opposed to a green check mark. And I'll know to investigate and see, where my model may have broke. So you'll see basically at the bottom of every single model, I have some type of check there. So, that is basically, the model integrity aspect of it. And so once we've built out the 3 sets of statements. We've built out, or we've checked that the model actually works and there aren't any linkage errors and everything. Now we get to the point where we can actually start to sensitize the model. Really here, it's important, to go back to what I said earlier about ensuring that your inputs are organized in a manner that it'll be easy to identify. Because you don't want to get into a situation where I say, well, I think the margin is going to change by 10%, for example, and I have to go and find that, formula, find that expense, and then change a 5 to a 10 or something. I want it to pop out at me and basically go, okay, these are the blue cells I'm going to adjust, and I'm going to adjust them accordingly and see how it impacts the model. So to be able to properly sensitize, good modeling practices are paramount. So things you may test on the right-hand side here are things like margins, variable cost rates, growth rates of the revenues, any of the revenue drivers you might want to look at, like, if website traffic went up to 2 million as opposed to 1.5 million, how does that look like? Capital expenditures, and then also delays, right? So if I push my cash flows back, or if and a certain project takes 9 months to complete as opposed to 6 months to complete, how does it look like for the rest of our model? Generally, if there's a big project like that for that business, we would, custom tailor the model to allow for sensitivity in terms of any project delays or product delays as well. On the left-hand side here, we're talking about covenants. So this is, I'll take a step back here. Covenants are, metrics that are required or by a lender to ensure that the loan is not in default. So if I'm lending money to you, I may want to make sure that you are generating enough cash to actually meet my debt service or meet my interest and principal repayment schedule. So I may look at things like how much you're earning relative to the amount of debt that you have. And it's good to be able to build a model out to be able to track out how these covenants look over time and to demonstrate to a potential lender that you will not be in breach of these covenants and according to your model, and that there's actually sufficient cushion as well, so that if we play with certain assumptions, we're still not going to be in breach of any of our covenants. So being able to sensitize the model is something that is really one of the key benefits of even building a model out, because it allows you to see what happens in different types of scenarios. So here's an example of certain covenants I might look at. So like debt to tangible net worth. So the debt number and the tangible net worth number are just driven from my model for each period. I can calculate the ratio and see what the covenant is, and look, my debt to tangible net worth is actually under what is stipulated, so I pass that covenant. And I can look at, well, if I increase the amount of borrowings, or if I don't perform as well and basically my net worth comes down, how does that look like? At what point am I actually in breach of these covenants? And you can see that, in this case, or this example, there's ample room over, or ample cushion over and above that covenant. So the key takeaways really I want to stress in this whole presentation, I think the first bullet point is probably the most important. It's really to understand what are the business drivers of the model. So you could have the most mechanically advanced model out there, one that is very clean, very crisp, lenders or investors would like to look at it. But if the assumptions underlying that model don't make any sense, at the end of the day, it's not a very good model. It's the adage of garbage in, garbage out. So it's important to understand what the drivers are first, understand how we're going to actually come up with those assumptions, what research or what, basically what research do we have to support it, what experiences do we have to support those assumptions, and then, how do we translate those assumptions to mechanically fit into the model. That's the important part, is that the drivers have to be identified first, which then drives the model, not the other way around. It's important to understand basically your operations and be able to forecast out cash. I think for a lot of startup companies, cash is really a key indicator, right, in terms of what is the cash burn of this business? Is there enough cash left? How long is that runway? How are they planning to do that next round? This model, or the point of modeling, is to be able to help answer some of those questions. So that's really kind of the third point as well, right? Is forecasting cash flow movements to identify financing gaps and forming the basis of a financing proposal. On the lender side, or I would call it the investor side, seeing the assumptions in a transparent manner will allow an investor to have a greater level of clarity in terms of assessing really the risk of that model and really the risk of that business. It will also be able to help answer a lot of the questions that an investor may ask. I've tailored this more towards a startup perspective, but looking at when a business is actually going to be profitable, when a business will actually be able to start, or will it be able to meet its debt obligations, things of that nature are going to be important to a lender or to an investor. So with that said, I'll open the floor to any questions in the room.
Great, and if there are any questions, you can put them in the Q&A or into the chat area, or raise your hand and we can unmute you. You can ask a question. While we're waiting for anything to come in there, I had a couple that I wanted to run by you. One would be the, so on the discounted cash flow for the valuation, which obviously that's a big sticking point for a lot of us when we look at opportunities, is what is this valuation? Is this the right valuation? We spend a lot of time on that through our screening meetings and then trying to help founders with that. Would there be different discounts? I'm assuming we would look at different discount rates for different business models. So whether it's software versus hardware would probably have a different discounted cash flow analysis that you would do, or SaaS versus one-time software, with software one-time sale with updates. Or a razor blade model of a product sale. Are there any guidelines that you would look at in each of those types of business models as far as discounted cash flow to look at?
Yeah, for sure. I'd step back first and look at really the stage of the company before getting and dicing it into the business model of that business. In terms of guideline discount rates, generally I look at things like again, what stage of business is it in, and what's the size of that business? So if you're looking at single digits, so like 0 to 10%, you're really talking about large infrastructure projects. You're talking about large public companies. So probably not very relevant in this space. 10 to 20%, you're talking about smaller public companies, or you're talking about larger private companies. So again, we're talking about mature companies here. 20 to 30% is generally when you start looking at small and medium-sized enterprises. Again, it depends on the cash flow, but I'd say there's maybe an overlap. Maybe I'd say like instead it was 10 to 20 for the last range, and maybe 15 to 30 for these like SME type businesses, and then there'll be like 30% plus for when you're looking at about venture capital, right? And so that's a very wide range, right? It's 30, maybe tops out at like 70, but that discount rate is really a source of professional judgment, and it depends on a host of factors. When you're looking at startups, or you also want to assess the reasonableness of the forecast. So you don't want to be married to one particular discount rate, because the idea is that the discount rate is inversely correlated with the forecast. Or it's correlated with the forecast. So think of it as, as the forecast goes up. So you don't want to be married to a discount, because think of the idea of, you give me a projection that says you're going to make $10 million a year. And I go, okay, your type of business, that should be a 30% discount rate, right? Then you go, well, I don't think it's going to be 10 million a year now. I think it's going to be 15 million a year. Well, if I'm married to that discount rate, the valuation just went up because you manipulate your forecast. Rather, you have to really look at, that extra $5 million of additional cash flow now that you're projecting is riskier than the first 10. And so the discount rate has to increase. to your point on, what discount rate you would use for different business models, what we would do is we would look at research as to what other companies in that space are valued at. And then we will look to public to provide some guideline. What we see is recurring revenue models have the lowest discount rates, and by that virtue have the highest multiples. When you are in a recurring revenue model, you get in a situation where you have customer stickiness, you have visibility on who those customers are. There is certainty that you'll be able to repeat that revenue that you had in the last year, for instance. When you're talking about models that are more, one-time sales like, or driven by, getting a big major client, those are going to drive down value, which means the discount rates are coming up. So, it's specific to each business. We'll look at it when we're doing our evaluations to understand the business, understand where it's at, look at comparables, look at anything we can look at in the marketplace. There's a whole slew of factors that help us drive and understand what that discount rate would be. And then in the startup space, the other big factor is also going to be, well, who's the management team? Great ideas are brought to fruition by great management teams. So, if we see that this particular entrepreneur that we're working with has been involved in a lot of successful exits, well, in theory, that lowers the risk of that cash flow because you have a good driver at the helm. So, that could also be a factor there as well. So it's hard to distill it and say, 30 to 35% for recurring revenue model, 35 to 40% for hardware or something like that. You really have to look at the specifics of that particular business.
Okay, but I'm assuming the more that the founder has come up with reasonable assumptions and can identify their key assumptions to drive their model, the more validity we would be able to see in a valuation that they've come up with, or for us to be able to start to identify, is this a reasonable valuation that they have in the business?
Exactly. Like, the discount rate is a measure of risk. The higher the discount rate, the more risk inherent in that cash flow projection. So if an entrepreneur comes to you and says, I've already talked to customers A, B, C, D, E, F, G, A, B, C, and D have already signed on board, and that's the basis for how I'm projecting the revenue, that's a lot less risky than, well, the target market is $1 billion. If I get 1% of that, I'm going to make $10 million that year, right? Like the former, you can actually see what activities that entrepreneur is going to undertake, who they've talked to. You can actually inspect, certain contracts are already in place, how much revenue is being generated from those contracts. That's very solid. And so if they're forecasting about $10 million, you may put out a lower discount rate versus someone else coming to you and saying, I have this idea and this is the market and that's what I'm going to achieve by virtue of being in this market. That's a lot less compelling of a story. So you're going to put a higher risk rate into that.
And then I'm assuming the offerings that BDO have, so you've got your Start Smart program, that the initial package you guys have in that would help the entrepreneurs to be able to start doing this financial modeling. Is that is the financial modeling part of the packages you have for the startups?
Yeah, for sure. And so the financial modeling tends to be it's a one-time engagement in terms of building the model out, and then we can be brought in to assist with maintaining or updating that model during different intervals. So it's definitely part of that Start Smart package. I think it's something that is, very, obviously I'm biased, but it is very important to be able to demonstrate, what your projections look like, and to be able to build a budget for yourself, keep yourself on track, plan around that. I think those are all very good business practices that whether you're just starting up or whether you've been in business for 20 years, this is just something that we do. Like internally at BDO, we build our own models to look at how our group is going to do, and what do we need to do to to meet certain targets or what have you.
Okay, great. I'm just, Frank, I am unmuting you. You wanted to ask a live question.
Yes, thank you, Galen.
Yeah.
Can you hear me, Daniel?
Yep, for sure. Loud and
Well,
clear.
first of all, Daniel, thank you for doing this. I'm a big fan of BDO. You guys are really awesome at sponsoring the ecosystem, including NACO. I know you have 3 amazing packages: Start Me, Exit Me, right? Right, you have the 3 packages that you have for entrepreneurs. So I'm just giving a shout out, but I need your help. I literally got off the phone just before this call. It's a great company. I would love for them to talk with you if they would take me up on it. The valuation, it's in the med space, digital, no IP yet, no real contracts yet, 35 million US valuation. So I've been trying to get them to say, listen, I appreciate you talked to an accountant and he put this on there. If I saw that as a valuation from you guys, I would be a little bit more comfortable. No disrespect to this other accounting individual, but I'm struggling because I can't seem to get them to understand that as an investor, first of all, as an angel, I don't even want to talk to you if you think you're worth $35 million. As you know, we have 1 maybe per year that's a $1 billion company, while the United States has 10 per year. We had 1 billion. So I'm struggling. I don't know what to do. I invited him to come and participate today. As a matter of fact, one of their mentors is one of our members, but they're so fixated on the validation, but no IP, no real contracts, no revenue. What do you tell somebody, Daniel? Because I'm at my wit's end, and all I can say is good luck, and I wish you well.
Right, and you know, quite frankly, sometimes that's the answer, right? Is an investment or a transaction or a partnership really takes place between 2 individuals, and there has to be an overlap in terms of where you see the value versus where they see the value. You know, without understanding specifics of the business, it's difficult for me to assess whether or not their valuation is valid. You know, but generally, we would like to see that there's some semblance of you know, a plan, right? Some semblance of, well, how are you going to get those revenues? What customers do you have in place? 35 mil is a pretty big ask. Like generally, with even more mature companies, especially in the private space, like generally what we're seeing right now is that revenue multiples are somewhere between 1 and 1.5x. So what that means to me is that, you know, if you're a $35 million company, you should be generating about $35 million of revenue or net revenue on an annual basis. So maybe that helps give some ballpark, some guideline. You know, I see a lot of these $35 million valuations are because they're projecting out like $150, $200 million of revenue 4 years down the line, for example. And I think you have to then assess, you know, does that make sense to you? Are you willing to partake in that risk? Because 0 to 200 it tends to be quite a jump. And the other thing we see too is that generally, in terms of business valuations, there tend to be, and it depends on the business, you know, I'm talking more from a traditional sense, but there tend to be like valuation black holes that you need to jump as you progress, in the sense that, you know, going from a $0 company to a $1 million company is very easy, but for whatever reason, like jumping over $7 million is one of those black holes that you have to go through. And it's, you know, it's common business challenges. Like, you know, when you're a $200 million company, the way you're going to manage it is very different in terms of, you know, who's at the helm, what governance is in place, what's the strategy, versus as an entrepreneur, you know, like it's one person basically running it, right? So there's all these things to consider in terms of, you know, there's a lot of risk when you're talking about that level of growth.
Well, thank you for that, Daniel. Galen, the only reason I mentioned this is a company that me and Angelo have been mentoring, and the plan was to bring him to the Angel Group. And the last valuation was around 10 million. And to be quite honest, the technology is pretty cool, but I'm asking them to back it up with IP. And I made the introduction to Mark and Clerk, who look after us quite well, like you guys do. So they're in conversation. But my real concern was that it was 12 million, no more than a month and a half ago. And now it's 35 because of COVID. That's the one that, because, you know, at 10 to 12 million, we as angels can kind of swallow it if you've got something in the back end, a great team, and the IP is there. But, you know, because of COVID, it went up triple.
Yeah. But I think, again, you know, to Daniel's point, I think if you can validate what it is you've got, this is a better way to do it. And I know that, and Daniel, I kind of took over the screen there from the sharing because I did have a question that came in from one of our members asking, how much is the Smart Start, which is actually, I think, Start Smart package, and what does it include? So I just kind of threw that up there just so people can see what some of the services that BDO offers at the very low end, and then they also have a scale up. So there's a startup version, and then there's a scale up version, which, you know, I think, Frank, happy to share this with you as well if you want to get this in the hands of that entrepreneur, that maybe this is a great introduction to what BDO can do and can help them with, from helping to validate the valuation.
Yeah, exactly. And just to add on to that, and thanks for putting this up, Galen, with our Start Smart programs and our Scale Smart programs, they're very much a la carte programs because, you know, our understanding is that not every startup is going to have the exact same problems as each other. So, you know, it's very much, you know, what are the key themes with respect to that company or that startup or that scale up. And then we basically provide, you know, what we think are the right types of services for that theme. So, you know, if you're just launching or you're looking for funding, it's very different from, you know, when you're exiting, for example. So, you know, that's the way that we look at the startups and scale ups is, you know, what theme do they underlie, and then how can we assist from that perspective?
Yeah, and I can certainly see in the Fund Me section, that's where you do have the capital raise support, financial modeling, valuation support, pitch desk assistance, right? And so I think for any of us that are working with startups, you know, these are very valuable tools that will help them to defend what they're doing. But at the same time, if we're going to syndicate, again, if the startup has something in their back pocket where they've done these things, it makes, I think it gives them a better leg to stand on to defend their position, and for us to feel more confident that they've actually had a professional helping them through the process as well. So, all right, I think we've kind of run a little bit over time. I see that we are dropping some folks off of here. So Daniel, again, thank you very much for your time. It's very educational, a lot of great information in there. I think we'll make sure that we get this out to our audience. I'd like to, if I can, with you, and we'll see if we can organize also a similar type of presentation like this for the startup community. I think that we've got a lot of our portfolio companies that we've invested in that would probably see some value in also looking at this as they start to make their move into trying to attract VC money, and I think to make sure that they're paying attention to the right places. This is I think some very, very good information for them to have.
Perfect. Well, thanks for having us, and take care, everyone.
Wonderful. Thank you very much, everyone, and hope everyone stays safe. And thank you very much for all your time. And thank you again, Daniel. Really appreciate it.
All right, perfect. Take care.
All right. Take care. Bye now.